Welcome back, everybody, on a new episode here at Cyber Traders. I have my good friend here, John Hutchinson, and I'm really excited to talk about him because we're going to talk about why people are so bad at options and what really does work. Because he was telling me a little bit more about the kind of option style that he does, which is actually my favorite out of everything that we need to do. But obviously, like anything, we need to learn how to trade before anything. But he's a very big guru, been around for over 15 years in this industry. And we're going to talk a little about exactly his style, what's going on, what he sees, what's going on, maybe some good options calls, something that you probably want to learn and how to apply in today's market. Because let me tell you, it is getting pretty damn volatile here. So, John, welcome to the show. Good to see you.
Fausto, thank you. It's been so long. It's nice to have a chance to reconnect.
Yeah.
I think we were talking just before you started. We started up here. The last time we saw each other was at the Marriott in New York at one of the Money Expo or Trading Expo shows. And boy, those were the heydays, weren't they? Those shows
They're
were
fun. They were a lot of fun. We what's nice about those shows is that I actually just spoke to a student just now that just after all the years he just when I just got off the phone. That's why I was a little before I spoke to you, just became a student of mine. He's like, Fausto, I remember at the money shows and we were there and I'm like, and it was like 10 years ago. You know what I mean? So the good thing that I want everybody here to understand is that sometimes it takes, John, it takes some time to people to get used to you, and I always tell everyone you should sample a little bit of everyone's stuff, but just don't get too married to them. It doesn't work out right away. But if you get it, then stick around. And you know what? He came around. I was just really excited to see, to see somebody after all these years. And, talking about the money show. Yeah. I mean, that's how far back this one student was watching. And yeah, those were really, those were pretty chaotic days. And they were a lot of fun. I mean, how many people usually go to those shows? I mean,
they used to be like 10,000. And then, it declined. And I remember being on the floor in Las Vegas during the 2008 Traders Expo. That was when the first bottom hit during the great financial crisis, and nobody was talking on the floor. I mean, you could just see, and nobody knew what to do, and everybody was just like, "This is the end of the world." And actually, I want to start out with a positive message for all of your listeners and all of your students. And this is the dumbest thing that I could possibly say, but it is the absolute truth. The S&P 500 in its entire history has never failed to reclaim a previous high. So no matter how difficult things are right now, and they are, no matter how worried, nervous, scared anyone may be, trust your process, trust your rules, stick to your rules, but also use this time as a way to learn something new, learn something old, right? Review your processes and learn from that. Trading is an art as much as it is a business for every person, as it is for me, for you. But don't forget that markets will always reverse. They will always, the S&P has always made it back to a previous high. But the opposite of that is not true. The S&P has not always reclaimed a previous low, right? Since 2008, we have not seen S&P 500 800, right?
Right. Other than a catastrophe.
Things will get better. We're in a really tough period. If you trust your processes, if your students are sticking to the rules that you're teaching and trading with them every day, things will work out. And I know it's hard to see sometimes. It's easy to say, it's hard to feel, it's hard to believe. But if you trust it, it will happen. It will take some time, but it will happen.
I think everyone's issue, John, is that they're all afraid to buy at the high. You know what I mean? Like they're worried about chasing. They're worried about and like this week, I do a lot of on social media, and I do a lot of these shorts. And one of the big things that we were focusing on was what the hell's going on with Tesla. Tesla is you see, because they're worried about they thought they were counting their chickens, eggs before they hatch. And Tesla was at at almost 500, went from 200. Now we're back down to these lows. And I think that's why we're a little concerned. So I know that, it's not like they're just buying the S&P sometimes. Sometimes it's kind of like buying some individual stocks. And there's always going to be these catastrophes and everything. And I think timing has a lot to do with it. I think everyone just has to understand. I think you've been doing this a long time too. You just got to be able to be patient, and just get at the right price. And then sometimes you just got to take a profit, it's
we even in business, we all have the same message, right? A penny or a dollar profit is still a profit.
right.
And in our trading, and as you briefly mentioned, we are option sellers. So for anyone who buys an option, we're on the opposite side of the trade. And that means that we're generating income from our trades. We're not looking necessarily for the trade for a stock to go up by X%, right? We collect income first, and then we manage that. And our tactics have had to change in the last 6 to 8 weeks to reduce the goal of our net credit. So for example, if we sold an option for $1 premium or $100 per contract, we typically would aim for 70% of that initial credit. So a $70 profit on $100. Now we've had to move that lower to 40 to 50%, because the volatility in the market has changed. The best way to understand this right now is we are in a hamster wheel of headline driven uncertainty. And that's what is making it harder to trade temporarily. Eventually that'll stop. Eventually that will abate. But right now, man, I mean, it's like you go back to mid-February to early March, and it was like every day was a tariff headline. And the market was reacting to that every single day. And that, I mean, we had to trade on and watched the S&P move up 1.5% in 90 minutes on, I think it was February 28th, the last Friday in February. Like, that's unheard of in the last 90 minutes of the day. Right. And it was a headline driven move. I think it was the Mexico, we're going to put tariffs on China and throw in a taco truck. And then by Monday, they said no to that. So, but like, that's the environment that we're all trading in. So what we've had to do, even with our own processes, is where is the profit line for us, and what's enough profit for us to say, let's take this and move on to the next trade, right? As well as I do, trades are like airplanes, right? There's always another departure time. Right?
That's right.
You're never going to be short of trades or trade ideas. And as we've been talking with many of our folks who are a little more worried, they tend to be a little older. They rely on that portfolio to generate income. It's like sometimes not trading is the trade. And when you can't really see what's happening, in other words, you look at a stock and you don't know, is this going to go down further? Like Tesla. I don't think anyone thought when Tesla hit 250, even I thought, oh, it's got to bounce back to 300 at some point. And then it didn't. If you can't really feel it on a trade, then don't make the trade. And there's nothing wrong with saying, I'm going to wait. I'm going to look at a different stock in a different sector. I'll do a review in a few minutes of something that I went through with our subscribers just a week ago. And it's surprising, but it's indicative of there are trades out there that can be made. You don't just have to be bullish or bearish. You can still be somewhat neutral, but it's if you trust your process, the whatever your individual viewer's process is, you'll find the right trade to make. But don't be afraid to take smaller profits. There's nothing wrong with that.
Well, let's talk about a little bit about your style too. Let everybody know because here we are talking about, like, I'm more of a day trader, I'm more of a short-term swing trader. I do long-term investing. I mean, tell everyone a little bit about your style, because I am a fan, actually, specifically of the way you trade the options market.
Sure. So across the variety of trading approaches that we take, we're looking to capture income from very short-term trades, which may be 0, 1, or 2 days to expiration, to longer-term trades, which may be 30 to 45 days to expiration. And the key objective for us is income. What we teach is how to leverage your portfolio, selling options to generate income. That's the flow. What's key to it, though, is two things. One, we largely started out, when we first started this business, we were largely selling cash secured puts or covered calls. And the difficulty there over the last 7 years is investors have started to get priced out of the best stocks. For example, Microsoft, when we were originally trading Microsoft back when it was down around $75 or $80 a share. Now it's in the upper 300s.
Right.
Well, on a capital basis, 7,500 versus 30,000 is difficult for selling an option. So over the last 5 years, we've had to make a major shift to teaching people how to use credit spreads and debit spreads and different variations, but still with the objective of generating income. So the idea for us is we don't want to be in a trade for a long time. We're trying to generate income on a weekly basis. And that's so from in any particular week, we may have 10 to 15 different trade positions on. And we're looking to, like I said, if we're selling for $1, we want to get out as soon as possible so that we can turn that capital back into another trade. So a little bit of art of velocity to the trading process, but it's all about income. And income has been tough in the last 6 weeks.
So the goal is you're not trying to make money on the stock. You're making money on just, as as rental.
Yes,
like you're
exactly.
Basically, you own the stock and you rent it, which, by the way, I'm a huge fan of that out of old option trade. I always find that, I'm always finding people that start into this business. The first thing they want to do, they get sold this idea like, why buy the stock? Just trade the option. It's cheaper. You could do this, but they don't realize that like if you ask Chat GTP or anything, it's like the highest failure rate in the industry, right? So, and I always tell everybody, you can't be a good option trader if you're not a good stock trader, because moving the stock that makes an option move, and that's how you basically would know. Then you'll know why to trade an option. But in your situation, that's a different story. You own the stock, and sometimes, and you're looking to make money. But in your perspective, people have to understand, it's like, hey, listen, if you own something, why not selling it? Get paid on it too, on top of it.
In one respect, that's absolutely true. The biggest difficulty for options buyers is you have to be largely right on every aspect of the trade,
right?
In terms of direction, time, and the move. When you're selling an option, you don't have to be right on all of those components. The only component you have to be right on, for example, if I'm selling a cash secured put, that means let's say the stock is trading at $50. I'm using $5,000 in capital to support the sale of the put, but I'm getting paid the premium. I'm collecting the income by selling the option. Now, if the stock is trading at $52 and the stock moves down to 51, I'm still going to have a profitable trade, right? I don't have to get the direction right. I don't have to get the time right. The time decay works in my favor. It works against against the options buyer. That's what we're leveraging, right? So the reason it works is we can own or not own the stock, right? If we sell a cash secured put, we are short the stock technically, so we could take assignment, but we don't have to take assignment. When we're selling covered calls, we'll buy the shares and sell a call out of the money, typically 2 to 3
just in case it goes against you.
Yeah, and
like insurance policy.
We're getting paid in multiple ways. We're not big experts in crypto, to be blunt. I know it's huge market right now, but
you got all the ETFs, so IBIT and all them, they're all doing,
But the BITO ETF that was came out early last year.
IBIT from BlackRock.
We started trading some of those because they were paying dividends. So we would buy shares and collect the dividend, sell a call, get called out, or just sell the shares back at market. But we were collecting income in multiple ways. So my favorite way to explain option selling is this: when Wall Street is taking significant long positions in stocks, they will hedge those positions by buying put options, or conversely buying call options if they're short a position. So in one respect, the person buying options from us is Goldman Sachs, right?
Right.
Because they're not using those hedge positions to make money. They're using it to protect their significantly large positions in a larger stock, like your Mag 7s, your Nvidias, your Microsofts, your Apples, etc. So they will buy those put options to hedge their position. So if there's a short-term downtrend and they generate some cash on that on that put position, it offsets the temporary loss in the share price. That's why they buy them. Now, you also have short sellers who will buy options because they think a stock is going to go down, or buy a call because they think the stock is going to go up. So there's a wide application of who's buying these options. And the hard thing for most people, the statistic is usually that options buyers lose money 80% of the time. And it is true, because most options expire unexercised or worthless in premium by their expiration dates. And that is why that statistic exists. That doesn't mean you can't make money buying options, because you can, but it's that you have to be right on all of those, all aspects of the options trade.
You got three things: at time, commission, and spread. You got to beat. People don't realize that,
and that makes it difficult. And with the option seller, even if we're wrong, we have ways to mitigate a loss. We can roll a trade out in time. We can roll a trade out in strikes. In other words, we can defend the trade more easily than the options buyer, because the options buyer essentially is saying they're faced with losing all of their capital in the trade, whereas we can extend the trade and have more time value to recover. In fact, I'll be blunt right now. We're doing that with the trade that we've had on with the SPX for 5-6 weeks now, where we were faced with we sold a short credit spread on Thursday, the 19th of February, and we got run over like a Mack truck the next day, and we were facing a $24,000 loss on that position. Well, we're not taking a $24,000 loss, because we know that we can work that back. And by rolling, by being aggressive in how we attack the position to defend it and to recover, we've whittled that loss down. We're still at a loss right now. We still have time to continue working it. But this is what I mean about trusting your process. If you're, and I just had this discussion with our members a week ago, you have a difficult decision when markets are as volatile as they are, when you're faced with a series of losses or losing trades. Do you take those losses? Right, everybody knows win small, win often, take small losses to protect yourself. But when those small losses start adding up, that becomes real money. And that's one of the things that gets overlooked. And one of the advantages we have as option sellers is, even when we're facing a series of losses, we have ways to defend them. Doesn't mean we won't still take a loss or of any value on a trade, because there will be times when we will. But when you can rescue a trade, man, you feel good. You really do. It's like, I didn't have to lose money on that trade. And I think right now, with the action in all of the indices and in individual stocks, I mean, it's hard. It's hard to pick stocks right now. Technical analysis in the way that I use it got shattered in the late stages of February, right when all the stocks just went like that. It's like your TA has to recover. All of your setups have to recover, and that takes time, and that can be frustrating, I think, for traders. But if you allow it to recover, you'll find those stocks that are going to revert to means or bounce higher. You find stocks that are going to break down further. But the key especially for us as option sellers, is maintaining that focus on where can we generate premium income today, and what do we have to look forward in time to in the next few days. What's on the economic calendar that could upset or upend the markets? What's driving the markets higher or lower right now? One of the things I'll share in a second, Dow theory turned bearish March 14th. That's a warning sign. Doesn't mean it's the end of the world, but it's a warning sign. Right? So does that mean that we want to be more cautious in our trades? We want to be shorter in time so that we can turn trades over faster, which we can do as option seller. I think the one I'll call it a misnomer about selling options is, just because I sell an option that has an expiration of this Friday does not mean I have to hold that trade until Friday. I can close it on Wednesday. I can close it on Thursday. I can close it anytime I want.
Okay.
And that's where closing at a profit has been able to keep us safer from losing trades in the last several weeks. Like I said, pulling back our goals in terms of what we're targeting for premium has helped us to avoid the daily gyrations in the market and to be able to get out of trades with more profits. Especially in the last several weeks.
What I'd like you to do is that I would like to show somebody an example, regarding about, like, I have a position right now, and shows, if you can, I don't know if you could show somebody like what I can actually get paid if I sold that stock. Like, I own it. It's in my account. And I think people need to understand it. And by the way, if anybody here, I see people clicking on it, if you want to learn more about John and his style, on the top right-hand corner, you got your phone. You can scan the QR code. We got a workshop that's coming up with him. So just make sure you take your phone, scan that QR code, and we'll get you in that workshop that we got going on to kind of see it live. Because once again, this is more of a podcast. And, if you want to see an actual full workshop, we'll do a little brief one here, but we'll give you a more detailed one. So please go out there and do it. So if you could, John, bring up your execution system, we'll share your screen. And I don't know if do you have a platform you can bring up? I don't know if you have an execution system.
I'm going to have to modify it, but I can meet your request. Give me just 1 second. And
not to throw you off. I know we had a little quick PowerPoint we want to show everybody, but we've been trading Tesla really a lot. And a lot of people like to have stocks in a portfolio doing swing trading. And like you just mentioned earlier that, okay, you're trading to make money with it, but you can actually sell it and make money and get paid a premium on top of that. It's just to kind of tell everybody a little bit, and everyone here is going to see her coming on. Some of you, if you read my book, I got involved with this. One of the persons was my sister, actually. Crazy trader. She would do like 200-300 trades a day. Probably one of the most active professional traders. Great trader, never made money because she spent it all in ticket charges. So she finally she met her boyfriend now. Never understood what he was doing. He was doing what you're doing, John. She would sell options, and she never, like some day traders like us, were like, we're so fixed on something like, what, this works. And she never really understood that part of the business. And now she's like, she's getting paid like $5,000, $5,000 on a premium of selling her stock. Like, she's just owning it. She's got a portfolio. She's like, I'm just selling it. I mean, I want these stocks to go up, but I'm also making money selling it. It's almost like getting like a dividend of something on it. So I think people need to see something like that, how it works. And like I said, if anybody here wants to join that workshop, that we'll do a more detailed one for an hour, just take your phone and scan the QR code on the right-hand side. All right.
Let me, I'm going to share a window here, see if I can do this. Let me know if I'm, is that good?
Yeah, there you go.
Yeah. So let me just talk you through this. This is one of our trading programs. It's called Income Masters. The objective is selling options. And this, you can see, this is what's been happening to us from January through March. Just to give you a quick understanding, we've largely had to turn to mostly spreads and mostly put spreads, where the objective is I want to be in and I want to be out as quickly as possible. So two things that point out, the column here, I can't highlight. So we've got column here, that's the capital. And then this next column over is the cash generated from the return. And then the final column on the far right side is days in trade. And you can see there's a pretty wide range of the amount of time we've had to spend in trades. So these 87 days, for example, over here on the far right side, those are trades we had to recover. We had to defend and ultimately exit, thankfully, with a profit. But it gives you a sense. You can see sometimes we've been a trade as little as 2 days. So that's a nice in and out. These are based on our spreads being typically most of the time they're 10 wide, so maybe $1,000 max capital. So we will typically trade 4 to 5 contracts per trade. So you can see the absolute capital in this particular Domino's pizza trade right here. There's a 10 wide put spread, lasted 2 days, traded 4 contracts, 3,600 in capital. We made $250, just short of that. A 6.9% return on capital. But you can see over the first quarter here, just at minimums, I mean, people with larger accounts can certainly utilize more contracts. But what this has done for us is we're getting a steady stream of cash. and at a time when the market is, really, really volatile. But I'm going to switch out to Yahoo, and let's take a look at your Tesla and see, is there something there that we could actually look at? And I'm going to use Yahoo because I don't have, I'm at the home office, so I didn't have my trading platform, but this will do enough for us. I mean, we could see, all right, so you've got a solid uptrend short term developing in Tesla, and a pretty clear bottom down there at 273. Dates all the way back to March. So start looking at the 270 line. That's where I would even start looking at if I'm considering selling an option. Now, Tesla being $270 to sell a single put is $27,000 in cash. So that would be an awful lot of capital risk. Right. So in the absolute sense, what I would be looking at is constructing a spread, which I have to do the hard way here, but we'll get close enough. Let me go to the straddle this, and I don't want this week's expiration. Let's go out 2 weeks just to see what's happening here. So if
I own the stock, right?
If you own the stock, you can sell a call.
That's what I'm saying. That's what it shows. I want to sell a call. So if I own a stock, and let's not even look at Tesla, because some people that's expensive. Could I sell? I own TSLL, which is the ETF. Are there options on that I could sell?
It looks like it. There are.
Okay.
And actually, straddle is always easiest to look at side by side, and they are weekly options, right? So let's say you own 100 shares. I'm not going to look at
shares. I own 1,000 shares. I have $10,000 worth of stock. Okay, I want to make money on my Tesla, on my and I want to make money on it. Somebody wants to buy it and rent it from me, no problem. Okay.
So last price, I would look out maybe around the $12 mark to $12.50 on the call option.
So that's going to take it away from me.
If it goes above, they could.
Okay.
That's a risk.
If I sold the the 1250 calls.
So the math on this is what's important here. So if you have 10,000 shares, you can technically sell 10 covered calls. So one covered call, 100 shares. You had 1,000 shares or 10,000. You could sell a lot of calls if you have 10,000 shares. May not need to do that many. But what you're getting here is you're getting $50 per contract sold. And you're getting that in roughly 10 days, right? This April 4 expiration. So that's the length of time. I mean, if I'm looking at the chart, it has not pushed above 12. So selling above a 12 strike on a call option against your shares would look like a pretty safe trade right now, because there's a recent high, 1186. I can't get this. That's good enough for now, right? Where is the recent high? And if it's up here, is it going to get challenged again? Probably not. So if I'm back looking at that option train, again, I want to say where's the return? Not this week, next week. And I'm going to say it's somewhere between this 12 and 1250 strike, probably the 1250, because it's a little further out of the money. There's less pressure from the stock right now. If I'm collecting $50 per contract, let's just use smaller numbers. Let's say I own 1,000 shares. I can sell 10 call contracts. I'm collecting $53, roughly, call it 50. So that's $500 across those 10 contracts on my capital. So my capital estimate here would be what I own the shares at, which we'll call it just $10, right? But that is a 500 divided by, it's a 5% return in 10 days. That would be a superior return.
So how much do I get paid on that?
You would get $50 per contract. So if you sold 5 or 10 contracts, that would be $250 to $500. With a 10-day window. So the option would expire in next Friday, April 4th. And you can close that at any time. So even if you take 80% or 70% of that profit, it's cash in the bank on your shares. And
So what's going to happen is, so let me get this straight. So people understand, because I'm acting like I'm stupid. I don't know anything, and sometimes as like, us gurus, when we talk to everybody, we talk a little bit over the top, a little bit more advanced than the people think. So just to kind of understand it, how it goes. Because there's so many, because listen, I get what you're doing more easier than other stuff, because I get told this all the time. I own so much stock. People's like, why'd you sell it? You make money on it. You know what I mean? You could make money on it, but I want to talk about what can go wrong. So if I could sell my 1250 calls, right? That means that I will get paid I get paid money regardless. I get the $500 regardless, right?
Yep.
Now, if it goes past 1250, they take it away from me. That means that person paid me the 500, but now he only has it for a certain period of time that he owns the stock after 1250.
Correct. So let's build a semi-hypothetical, and let's assume that you bought the shares at $11 a share. Just a simple number.
Simple number.
Or even selling,
simple math, $10.
Yeah, $10. So the two things to keep in mind: one, if your call gets exercised because the stock goes above 1250, you're still making the $2.50 on the shares plus the cash you collected on the call, which would actually be about a 30% return overall, because you'd have $2.50 plus 50, so a $3 per share return by selling that covered call out of the money.
So I still make the 250. They're hoping. So I'm making the 250 plus the 500 that they borrowed, that they paid me, but they're not going to get it until it gets to 1250.
Right. They're going to make the difference between 1250 and wherever the stock price is at a future point.
Right.
Because that's the call that they're buying. So
that's the call they're buying.
Right. So what would change the math on that is if you were buying shares at 1250 and then you got called out, then you would miss the appreciation if the stock went up. Right. That would be a negative trade. So you don't want to do it that way.
But they only own it that short period of time. So it's got to get there before it expires. So that 1250 expires when? In 2 weeks?
That was a 10-day trade, roughly. So next Friday.
Next Friday. Okay. Yep. And how do I know that somebody's going to agree to pay for that now? Like, do I have to hope somebody buys it from me? Or, like,
that's where I would be looking at. So we have volume here in the fourth column over from the left. And we can see there's pretty healthy volume in the call options from 11 up to 12. A little less volume at 1250. But it's still there. So there's still demand. I mean, if I correlate that to the put side, there's almost no demand here, but you can see that there's pretty high demand at the 1050 and 10 levels. Right. So volume is just another form of demand for the option at a specific strike level. And in this case, I mean, that's 1250, 300 to 900 contracts in those two ranges. That's fairly good demand compared to all of the other strikes in the chain.
Now is this like a stock? If someone has to execute me first, or they're automatically paying me that right now?
When you sell an option, you are collecting cash first. And the key thing to remember as an option seller is you are managing money you've already made. That's the trickiest part to it, because it's the opposite for the options buyer, right? They don't get anything until the option moves one direction or the other. As an option seller, you are collecting cash income first, and then you are managing the value of that cash. So if I collect $1, and this is always my trick question, if I collect $1 and I sell the option back, right? I close the trade at 50 cents. I've still made $50. That was still a profitable trade. Right. But that's for people who are accustomed to buying options. That's always that first mental hurdle to get over, because we think in terms of stocks and prices rising, whereas for the option seller, it's the price declining, the value of the premium falling towards zero, which locks in the total income or profit of the trade. I hope I slowed that one down enough for folks.
Now, for the listeners out there, let me just reiterate what he just said, just to understand. We're selling that option. I own the stock. So when people say, why buy the stock? Just trade the option. You could pay $500 for the option, right? Is that basically what it comes down to? You pay $500, but you got to hope it gets to 1250, right? So it's a catch-22. So that's why they say like options work out. why buy the stock? You can buy the option, but who's the cat and the mouse here, right?
Mhm.
So here I'm just a bank, and you own the
It's
stock,
exactly
and
what it is.
yeah, you're the bank, so why not just sell it? The only thing that can go wrong for me and you is that it goes past 1250, and now here's the person making it. All that money that I would have made on 1,000 shares. Let's say it goes to 1350. He's going to make the 1,000. I'm not, but he technically is down 500 because he had to pay the 500, right?
Mhm.
And so
It's
his
it's
participation.
it is a challenge. We call it getting run over to the upside, and we call it foregone profit. It's money you didn't have. You sure would have loved to have gotten collected it, but sometimes, again, it comes back to something you said at the start here, right? Any profit is good profit, and the hardest thing as a trader is that mental game of what could have been, what should have been, etc. Right? If you made money selling an option, then you made money selling an option. And I'm going to borrow the put side for just a second to illustrate that, because I'm looking here at this $10 put, the same expiration next Friday, and it's paying 61 cents per contract. That's a 0.6% return, 0.6% return in 10 days, which means if you could replicate that 26 times a year, it's a 15% return on your money.
Yeah, for doing nothing because you own the stock anyway.
Or in this instance, if we're doing a put where we don't own the stock or we want to rent the shares, but even on the call side, it's a 0.5% return over 10 days, and that's a 26% annualized return if you could do it every week.
So this is my concern, John, not to cut you off, but this is my big concern here, because I was like, my sister tries to explain this to me, and I'm like, she's like, because I had like, I don't know, I had like 2,000 shares at Palantir, and the stock was like 80, it was like $80 at the time. It was at 100. She's like, you sell it right now, they're going to pay like $7,000. She says, take it. You know what I mean? Like, I'm looking at it, but this is my concern about it, because you're an expert. What can go wrong? What has the stock goes down? And like, am I caught? Like, am I screwed into this that I got paid? Like, can I sell it, still be stuck into this put? I mean, sell into this selling this cover call? Like, what can go wrong? What can go wrong? I want to get out of it.
It's a very good question. It's a really good question. Let me deal with that in two ways. On the put side, if you're selling puts, the risk in selling puts is assignment, meaning the stock price falls below the sold strike. So in this case, the example I was looking at the $10 level, right? So the stock reverses below $10. I have to take assignment. Now I have a position that's losing money on the stock side, right? That's the risk. And the risk in assignment is that the stock keeps going down. I will tell you, in 15 years of doing webinars and selling options, the number one question when we're talking about selling put options has always been exactly this question: what happens when the stock goes down? I get assigned, and then the stock falls 20%.
Right.
In 15 years, it's always 20% in that example, because we're attuned to the bear market 20% kind of thing, and that is the risk in selling puts. The risk in selling calls where you own the shares largely has to do with where you bought the shares, or what your purchase price on the shares relative to where you're selling calls. If you're selling calls above, then there isn't any risk, because the call is above your share price. The risk in selling calls is if you sell a call below your share price. So in this case, let's say you're $10 and you sell a $9.50 call. Well, now you get called out at $9.50 and you're losing money on the shares. So the key to covered calls is largely trading them in neutral to uptrending markets, and always trying to trade, generally speaking, always trying to stay out of the money, but not selling covered calls when the price of the stock is below your cost basis on the stock. That's one of the keys for us. So if I bought the shares at $10 and the stock goes down to $8, I am not going to sell a call between $8 and $10, right? I need that stock price to get back to.
Sold at $12.50, right? Right, but I sold at $12.50, right?
Mm-hmm.
Now the stock is $8. I own it at 10. You know what I mean? I was making the premium, but now I don't want to get screwed. I own the stock right now. What do I do? You know
well,
what I mean?
yeah, and that's that again is so. Let's work backwards on the model. Let's say we bought shares at 10, sold a call at 12.50. The stock goes up, but doesn't go above, so we don't lose the shares. We still own the shares. We got paid on the call. We collected that income. That option expires worthless. That money is in the bank. The share price then falls to $8. We have to rethink: do we want to sell a call? It's not always best. Sometimes it's best to wait for the price to recover even a little bit. But if I were going to go back in and sell a call, I am going to sell that call at or above my cost basis, meaning that $10 per share original level. So that if I get called out, I'm getting called out at no worse than break even on my shares, but I'm still getting paid on my trades. And that's the key. The one lesson and the one tip that we always give is do not sell covered calls on shares where you've held them for a long period of time. And like an Apple, maybe you've held Apple for 10 years, where losing the shares would create a taxable event. That's number one to always be aware of. Or it is a core piece of your long-term portfolio. Because if you get called out, yes, you can buy back in, but now you're buying back in at an entirely different price level. And that changes the math on everything from your returns to your allocation. Exactly. So that's why it's always key to know what did I pay for those shares, or where did I buy those shares, or where was I assigned those shares, and work at or above that cost basis to prevent losses on the stock side. If the stock goes down to $8 and you don't have any sold call on it, nothing's happening. You're treating it just like it's a regular stock trade. You may want to expand your position, right? If the stock has come back down and hits a nice technical level that forecasts a bounce, it might be time to add shares, then sell more calls, right? So in times like this, it's definitely time to slow the process down and follow your charts, your technical analysis, your triggers, things of that nature, so that you know I'm going to get this trade because this is a high probability trade, but I'm not going to lose money if the trade moves against me. That is that key to, if I'm selling an out of the money call option, it's hard for the trade to go against you. The risk is the stock gets run over to the high side, and as you pointed out, I didn't get that extra dollar in stock price movement, but I did collect the income. I got paid for taking the risk of selling the option, and I got paid for the risk of owning the shares. So it's like I said, especially on the call side, we see it frequently. The most important aspect to calls, in my view, is selling them where you know if the price is going to go higher, you have options or choices available. For example, let's say I sold that April 4 12.50 call, and the stock price goes up to 12.50. Now, I might get called out, I might not, but maybe I want a little extra time. So what I might do in that instance is I'm going to come back to my options chain, and I'm going to say, instead of April 4, I'm going to go out 2 more weeks to April 17. And I'm going to say, okay, I've only got even premiums right now, so maybe I'm going to move that call up to, the 12.50 is not here, but we'll say it's 12, right? I'm going to get paid that to move that trade. Right, I'm rolling the trade, so that it's complicated, but I'll try to keep it simple. It's basically a 2-for-1. So I'm buying back the option that I originally sold, and I'm selling a new option, but my broker treats it as a single transaction. So I'm getting the net difference in that trade, and in this case, might be 20, 50, 80 cents, whatever. But what I'm buying is I'm buying time for the stock price to come back below that 12.50 level or whatever price level I'm worried about, so that I can then get paid on the call, but not have my shares called away. So that rolling function is one that we started teaching that back in 2014.
Okay.
And brokers really made it easy by combining it into a single transaction. So you only pay one transaction. I mean, you're still doing 2 transactions, but it's a single transaction on the broker screen, much easier to execute. And by moving that option out a couple of weeks, now I can let the stock do whatever it's going to do. and I don't have to make an immediate pressure decision to close the trade. If it's a loss or a losing trade, to take a loss, right? I can buy time and let the trade recover. That's I was explaining the SPX trade. Actually, I don't want to scare anybody, but it's probably going to scare people, but I'm going to show you anyway, because it's worth it. And it's what can I do? Let's go out to a 1 month chart. It's close enough, right? So we were selling way up here, and the market at one point, when the market was down around the 5,500, we were 400 points in the money on our spread. 400 points. That's max loss on an option. Well, what we've done is we have slowly worked that trade down so that we're now sitting right around this 5,800 line. So we've recovered or recaptured almost 200 points. So we're basically, what we're trying to do is this: meet the S&P in the middle. And at some point, that trade is going to be out of the money instead of being in the money as it is right now. That will allow us to exit either with a very small loss or potentially at no loss, depending on how everything. Michigan launches new policy for cars. Great. Thank you, Yahoo, for your advertising. Sorry about that. But that's the way to think about when I'm selling options. What's the worst thing that could happen with this trade? And generally speaking, because we're short-term focused, it is usually that the stock moves dramatically in one direction or the other. That is usually the worst case scenario, right? If I'm selling a put, it's that the stock goes down that 20%. If I'm selling a call, it's that stock goes up 10 or 15 points. That's your worst case. If you have a plan and can think through how to recover in an extended period of time, might be several weeks, then you reduce that loss or you reduce that risk of loss. You're not going to eliminate it because there's no way to always eliminate risk of loss. But if you can reduce it and mitigate or limit the damage, you're freeing up capital that can be used on a trade that can recover the loss on your next trade. That's the most important factor. It is a challenge. But it's fun.
Yeah, well,
that's why we do it.
John, what you explain is it's just so much. It makes so much more sense and easier in a way of it. But I think that people have realized that the reason such a big failure rate is people take the other side and don't realize the time. But running out of time here, just one last question to ask you: why, getting back to that Tesla trade, the Tesla trade, right? So I had a 10. I got taken away at 1250. And now the guy, I made the $500. Now, anything over 1250 he makes. Not owning the stock, but the person that owns the option, what happens if it goes down? Like if he bought a strike price at 1250 and now it goes down to 8, could he still lose? Or it's our side. We don't only lose. He just loses. He just loses the 500 and it expires worthless, right?
Correct. Yeah. So if you sold the 1250, you own the shares at 10, you sold the 1250 call, the options buyer loses money at anything below 1250 by expiration.
Yeah.
And they lose. Right. Exactly. They lose. Now we can also buy back our option at any point to lock in a profit. So keep it simple, let's simple. If we sold that 1250 call for $1, and 5 days from now, the value of that is 50 cents, but the premium value has fallen and it's now 50 cents. We can buy it back, lock in our profit, and remove the risk of having the shares called away. And then look at, can I sell or would I sell a different call option, a different strike, a different expiration, right? That's the advantage that the option seller has, is being able to say, I can take my money off the table at any time and I remove the risk in the trade. That's true on the put side too. If I sell a put for $1 and I collect 50 cents and I buy the option back, I've locked in a $50 per contract gain, and I can go look for another trade. Or if it's Friday, I can go to happy hour, right? Mm-hmm. I don't have to immediately. I've removed the risk to my capital. I've removed the risk in the trade. I've locked in a profit, and I can move on to either another trading option, another trading idea, or I can come back to the same one. We had what the heck were we trading? Oh, so this is a little dated, so please excuse me. But when Square was really on a massive tear back in 2018, 2019, we traded that stock 32 times for wins, 32 times in less than a year.
Once you know the trend of it, it's just easier,
Exactly.
like anything else,
Yeah, and so if you see stocks that have low volatility in their price action, like they're moving up, but they're not, you don't have wide bars, you don't have wide range days. Those are great stocks to look at for selling options because their price action tends to be more predictable. It's not guaranteed, but it is more predictable, and that makes them safer picks because you know that if that stock is going to keep trending up, I can follow that stock up. I can follow it with calls or puts and generate income each time that I can close that trade or that trade expires worthless. That's my objective.
Well, just to tell you this, because Shady on YouTube said that you basically explained it. He's like the best explanation I've ever heard. Wow. So you're getting people complimenting it. And I'm also wowed myself because there's no better. That's why I love doing these events when these people like you, especially I'm a big fan of what you're doing. And I'm still like trying to learn how to do this a little bit more because I own so many shares. I know a lot of people here do. A lot of my students are active traders and they own the stock. But now you're giving a supplemental of, hey, you own it. Why not sell and take the money? And you're going to get paid regardless. And the downside. So what we're going to do really quick, because we're almost out of time here. By the way, if anybody would like to see, we're going to have him back at the Cyber Expo. Take your phone, scan the QR code in the top left-hand corner before we close out. And then, John, you got a link for us just in case if someone can still follow you up in the meantime until then. Oh, there's the link right there. We just got it right here. There's the link. We'll post it up there. So there you got the tradersreserve.com. Click news. So everyone has the link there. And you have the QR code in the top right-hand corner. So we're going to have him back. But let me tell you, this has got to be, John, I'll tell you the truth, got to be one of my favorite podcasts I've done. I learned so much just listening to you because I need to learn how to do this right now. I mean, I just have so much money, out there in these positions. And, it's like a dividend. Why not take it? Right?
That's exactly what it is. You're creating your own dividend. You're creating your own dividend.
Yeah, and people love dividends. They love
creating money, and Wall Street pays you for this. Are they nuts? Wall Street never pays us for anything.
One dumb question I want to ask you that people are always going to probably ask the same question. What is the interest of an option brokerage firm do? How do they make their money?
Brokers make their money on the spread, the width of the spread. So the bid-ask spread is how the brokers make their money. So one last lesson is when you are looking at an option to sell, whether it's a call or a put, always pay attention to the bid-ask spread.
We're going to cover that in class. We need to go over that in the next lesson that we do. That's good because I didn't know that. I mean, 50% of my students, I tell them you lose money in trading because you don't understand. Some people don't realize the spread is like 50% of the failure rate in the industry, and some spreads in stocks are very, very wide. So I'm glad that you brought that up but we're going to save that. We're going to tease everyone that you got to register, and watch that because, everything sounds great. It sounds like a no-brainer.
We'll bring a couple of test trades to that one too, so people can see how to do it. And just a quick note that the link that you guys were so kind to share, that's our 3 times a week newsletter. We call it Filthy Rich Dirt Poor because we have to come up with an amusing name for it. But in our newsletter, Monday, Wednesday, Friday, we send it out at 8:02 a.m. Number one, every Monday, we are reviewing our trade results from the previous week. So if you want to see what option selling looks like in terms of results, trades, what we traded, how we traded, we cover that every Monday. And we also do a deep dive on either a stock analysis or a tactic. So understanding a cash secured put, a covered call, or variations therein. We also do on Wednesday and Friday, we will take a look at what's moving the market, right? What the key things that are driving markets. Like last week, we talked about Dow theory so that people could understand why it matters and how to use it in their trading. So this is just a week, 3 times a week newsletter. We take Tuesdays and Thursdays off apparently, but Mondays and Wednesdays and Fridays. So it's totally free. You can opt out at any time. I don't spam you. Believe me, I've been in business for 15 years. I know what it's like to get all that spam email. Believe me, I know. but
Well,
it's to help you get ideas.
It'll be a nice spam. It's a nice spam now, because now that the only issue, we spoke about this earlier, is that sometimes you do get spam, but it's okay. In at least you know who you're getting it from, and you're gonna learn from it.
Yeah.
That's all.
All right. I will save all my other good stuff for your May event.
Yeah, we definitely do, because this is the longest podcast I've ever did so far, and because I am so intrigued about it. But because I'm going to learn how to do this myself, and it's just been a great one-on-one lesson.
My last little nugget is keep your eye on Netflix. I think Netflix is a good stock to trade this year.
It's got good options, right? I mean,
it does absolutely. And my three key reasons, just to keep it simple, they were not affected by the Hollywood strike because they outsourced so much content from foreign countries. Although I don't know how many people are left in Sweden after all of the serial killer shows that they came from Sweden. So I don't think anyone lives there anymore. But number two, they unlocked the profit model when they eliminated shared accounts a year and a half ago.
You got a lot to that.
And I suspect that at some point this year, I don't know for certain, but I think that Netflix is due to split at some point.
They should be splitting. It's crazy. Same thing.
I know, 950 exactly. So, but I really like Netflix this year as a long-term hold and as a stock that you could sell options on or around. So that's my last little nugget. And you know what? We'll take a look at it when we get back together in May.
I can say it took you all day. Thank you so much, John, for being here. And everyone, thanks for listening in. And make sure you scan that QR code and make sure you register for his newsletter. We'll see you back here again. John, thank you so much, everyone. We'll see you back in the trading room. Don't forget, we will make some shorts out of this. Make sure you subscribe to the channel, like us, give us a thumb up, leave a comment. We'll get back to you on every one of them. We'll have some shorts, some nice 60-second highlights of what's going on, and the long version will be up on the end of the day. Just make sure you get to watch it. So if you did miss it, it'll be up there shortly. Thanks, everybody, for listening. We'll see you back here next week.
Take care, everyone.